content in this podcast was relevant when published on March 3rd, 2025. Current views may differ. Private markets today are rewriting the rules of finance. Companies are staying private for longer, secondary markets are booming, and sovereign wealth funds and family offices are reshaping global capital flows. Meanwhile, AI-driven innovation is shifting from promise to reality, transforming industries and demanding massive investments in infrastructure. So what does this mean for venture capital? Welcome to Crafting Capital. I'm Brian Kamenetzky from the Wall Street Journal's custom content team, coming to you from San Francisco, where the ripple effects of Silicon Valley's venture capital playbook are spreading across the world. Joining me today are two experts driving this transformation: Ben McLean, head of venture capital at UBS, and Alex Gurevich, managing director at Javelin Venture Partners. Welcome.
Thanks for having us.
Morning.
An influx of capital is allowing companies to stay private for longer. Ben, let's start with you. What are the key drivers behind this trend, and how are private markets evolving to accommodate it?
To unpack that, I think we should first start with the founder themselves. And there you have a bit of a conflicting interest around going public or staying private for longer. We've seen many come out and say openly that they have no incentive to do so, even if the window opens, for a variety of factors. One, it's simply a regulatory burden. There's a lot of admin and cost involved with going public. Sunlight is also a great disinfectant, and it means you have to start focusing on the myopic, the short-term costs. And a lot of these founders are dreamers. They want to break industries. They want to take down an entire industry themselves, and moving into the public sphere removes a little bit of the capabilities to at least communicate around that. The second is the evolvement of the secondary market, and that's been a huge value to early employees that have been tapping founders on the shoulder and say, listen, we're 10 years into this. My RSUs, my stock options are giving me tax liabilities. I need the liquidity. And stepping forward have been banks, have been secondary investors, have been platforms, a variety of markets that have provided that liquidity. And that's obviously kept things a little bit healthier within the organization. The third has just been the macro market, right? Aside from last year, where we had a few companies come out and test the market very, very successfully, by the way. 9 out of 10 of the largest IPOs were up on the year, from Service Titan, which was, I think, 45%, all the way through to Reddit, which finished almost 400% up on the year. So make no mistake, the liquidity is there in public markets. I think probably the overarching thematic is a massive outpouring of AUM coming from new emergents into the sector, whether that's sovereign wealth funds, family offices, or just VCs raising huge amounts of capital and able to support businesses for longer.
Alex, from your perspective, you've worked closely with early stage startups for over a decade. How has this changed the way that VCs operate?
Yeah, I started my career 15 years ago, kind of at the beginning of this trend of companies staying private longer. At first, it was actually more the mega hedge funds that would come in and invest a large amount of capital into growth stage companies, Coatue, Tiger, et cetera. And then you had the sovereign wealth funds and big conglomerates like SoftBank come in with big capital. And I agree with Ben, it's been actually a really good thing for our companies because they don't have to make short-term decisions. They can build for the long term and create massive enterprise value without that pressure of doing something unnatural or seeking a liquidity option before it's time, prematurely. And we've really benefited from that as a firm. Some of our biggest companies like Thumbtack, Masterclass, Niantic Labs, we've held for well over 10 years, and they're just at the beginning of their value creation curve. And these are multi-billion dollar, highly scaled revenue companies. But it goes to show you that liquidity is a big issue. Previously, the average length of a fund lifecycle was 10 years. Now it's 13.1 years. The time to a successful exit has increased by 50% in terms of time during that time period. Liquidity is still something that's top of mind for our LPs and for ourselves. And the advent of the secondary markets in venture is a relatively new thing. There's been direct opportunities for a while, but then you have interesting things like the continuation fund structures and strip sales. That's relatively a new tool for VCs to control when they have liquidity without putting that pressure on their portfolio companies who are in the beginning of creating that value, right? So that's been great. I mean, like just last year, I think 156 billion occurred in VC secondary transactions. 45% of that was in continuation fund structures. So it just goes to show you that it's happening, and it's a pretty healthy thing for the ecosystem, in my opinion.
So I'm interested in what this shift means in practice. So we're recording this in California, home of Silicon Valley. AI obviously remains one of the key factors driving company growth and disruption, but there's a difference between hype and reality. Alex, where are you seeing AI deliver tangible value, and which industries are leading that shift?
Yeah, look, I mean, AI investing is nothing new. It's been around for 10 plus years. It just had different labels. You had machine learning, big data, et cetera. But what's different is back then, you had these powerful models in the hands of a few PhDs, data scientists. But now, with the advent of these LLMs and Gen AI in general, it's democratized access to these powerful models and put them in the hands of everyone. And that's extremely powerful across pretty much every single industry. And the cost of that is going to be driven down even more so because you have these big players competing with each other, commoditizing over time. So we don't look at it as we're investing in just AI. AI is ubiquitous. Everyone is doing it. You have to. If you just look at the numbers, last year, 33% of all venture investing went into AI-related companies. That's $100 billion. That's an 80% increase from 2023. So it shows you that it's very ubiquitous at this point. We look at three big themes and trends that we invest in. We try not to invest too much in infrastructure and big LLM companies because it's very capital intensive. So the big three themes for us, one, are companies that have a unique IP or data advantage. So as the AI native technologies get better, these companies and their offerings improve, and they don't have to worry about the commoditization threat. One example of that is our company Masterclass. They have celebrities that teach online courses. So we use the IP from those courses to create digital twins that people can interact with one-on-one and have an incredible experience without having the cost of producing that class. The second theme is really around agentic AI. We are big believers in that. And the point there is, like, you have LLMs, they can do a lot of things impacting the digital world, but when it comes to impacting physical, real world outcomes, AI has a limitation, right? So you need something that connects and is a bridge. And that's where ChatGPT recently released Operator that allows companies that impact the real world to interface with ChatGPT. So these are companies that can help you with tax preparation, give you a personal executive assistant. We have a company called Thumbtack that actually helps with home improvement projects that you could plan with ChatGPT, but then implemented by using this company called Thumbtack. And then the third sector that we're really, really passionate about is really around security. And to me, that is the biggest gating factor for enterprise adoption. I think a lot of enterprises, and Ben can speak to this better than I can, they're dipping their toe in the water, but they're a little bit afraid of either regulatory issues or IP infringement or themselves somehow stepping awry of the whole situation. And so security, ethical deployment, fingerprinting, watermarking technologies, all these things are really important for enterprises to adopt. And if you just look at where the revenue is coming from for Gen AI, most of it is consumer. There's a little bit of enterprise, but that's really the big floodgate opening moment is when the security AI companies make it safe for these enterprises to adopt.
I completely agree with you. From a data governance, data sovereignty perspective, we're now at a point where enterprise is making decisions about which models to marry themselves to over time or whether to choose flexibility, right? And to look for cross-inference companies where you can then make the decision down the road which LLM you actually want to end up with. We're also seeing some of the native SaaS cloud architecture, think CRM software businesses start to give that model flexibility themselves. So 6 months ago, they were at risk. Their share prices were under pressure. There were articles left and right about new entrants to the market. Data lakes were so 2008. Now we're kind of seeing them rebound. And part of that has been this DeepSeek moment, right? The R1, O1 rival that has come out and kind of potentially slashed costs to the industry. And we've seen the distillation of that model already in the last 2 weeks across Llama and Hugging Face. And so we're going to see a lot more of this. What they did to come in at a base level, at a bare metal level, and come in with CUDA and innovations around the data library and NVIDIA's Nickel is very innovative to the sector. And we're going to see a lot more of this coming through. And that's going to be huge for venture capital. Necessity breeds innovation. And so the reality is at one end of the scale, you have a few companies raising huge amounts of capital and able to grow with scale. But it's actually those that don't have access to it that will drive forward and drive home some of that innovation. So that's going to be hyper interesting for us in the next couple of months.
Both of you have done a nice job sort of laying out the role that venture capital is playing in this broader transformation. But Ben, from your perspective, what are the biggest financial and infrastructure challenges AI startups face, and how are investors stepping up?
Yes, I would have answered that question differently only a few months ago. I think what we're going to see now in the next quarter is a test of Javelin's paradox. And Javelin's paradox is For those that don't know, a 19th century British Industrial Revolution quote that as you see efficiency gains, you actually see elasticity in demand. So what we may see over time now is model prices of post-training drive down so low that it becomes interesting for not just other startups to build, but actually enterprise themselves, to give the engineers the tools, to give them GitHub co-pilots, to actually go and build the models themselves and deliver that AI into the enterprise without potentially having to just give it to a hyperscaler in terms of new cost and revenue. So that's going to be the first thing. I think the second is a potential kind of cataclysmic event in venture capital itself, because the race to invest in these companies has created hyper-competitive rounds that not everyone can take part in. So you're starting to see a bit of a bifurcation in the market where some of the VCs that popped up in the last 5 to 10 years are kind of running out of the ability to chase some of these deals, both in terms of the price higher, but also the capital that's been raised. In reference to Alex's point earlier on the infrastructure side, the dilution is brutal. And so we're starting to see this kind of two-horse race where the capital accumulators at the top of the market are doing phenomenally well. And then the niche sector specialists that know what they invest in, but also know what they don't invest in, are starting to move forward too. And that's leaving the other 75% of the market behind.
So Alex mentioned this earlier, referenced companies staying private for longer. So Ben, as we've seen that shift in who's investing in late stage startups, what role are high net worth individuals and family offices playing in private markets today?
Yeah, so we know that many of the great tech firms of the last couple of decades have spawned huge innovation and new companies from them. In actual fact, most of the Valley positions themselves around those executives and engineers that spin out to form new vehicles. We've seen that in real time. We've seen that over the last decade in the ZERP era. The ability of those families to invest but also deliver value to the capital table is incredible, and that's why a lot of these founders actually want to work with them. Make no mistake, their appetite for risk is focused on a drive for profitability as well, so it's not just chasing deals for the sake of it. They're smart, they've seen multiple cycles, they have the ability to pick up the phone to anyone and everyone on the planet.
Alex, what's your take on this as it relates to the VC landscape?
Yeah, I think with high net worth, it's a question of access, right? And you have these very hot, fast-growing AI startups. They have their pick of the litter in terms of who they can raise capital from. And so if you're a large family office, right, that wants to get an allocation, how do you do that is a big question. And, I think one way is to go through a capital aggregator like UBS. And the other way is you can go through existing venture funds that have a position in those companies already. And they oftentimes do direct investment opportunities, SPVs, because they have a contractual pro rata right to that capital. But for us as venture investors, we actually prefer to work with high net worth individuals and family offices because oftentimes they tend to be entrepreneurs themselves. That's how they made their money, right? And for us, they understand the nature of what we're doing and the entrepreneur's journey, and they're able to help those founders potentially. They're able to understand what's going on with those businesses. And frankly, they have a hunger to know, which we appreciate and we love. And so we prefer to work with high net worths and family offices on those co-investment opportunities because of that type of profile that they have.
Ben, that sounds beneficial both for the investors, but also for the companies themselves.
Yeah, totally. And we actually see outreach left and right from companies looking for that, partly because $1 of revenue is actually more valuable than $1 of equity. Any founder will tell you that, particularly in today's world with valuations. And so the ability to build your cap table with people, as Alex said, that have real world experience in building businesses, but second to that, can pick up the phone and put you in touch with a CTO of literally any company within a specific sector, that's highly valuable. And it saves you time, it saves you headcount. And so they're very, very keen to be connected, and not just within their own sphere within the US. They're looking for multi-geography as they expand their businesses and look to drive home revenue themselves.
So this has been a really fascinating conversation. But before we wrap up, I'd like to hear your thoughts on the future. Based on what you've observed in Silicon Valley, what trends or shifts are you seeing that excite you most about where private markets are headed or where the next big opportunities lie? Ben, let's start with you.
I think liquidity is going to be incredible going forward. I think there'll be a lot of innovation at the top of the house from an LP/GP perspective to deliver a public market style liquidity ecosystem for private markets. We need to fix the mismarking that occurs across the private equity industry. And I think you're going to see a lot of startups pop up in that space. A lot of banks step in to provide that liquidity to early founder teams, to early investors, and really remove these kind of extended 15-year cycles in venture, which actually just don't work mathematically. They put too much pressure on VCs themselves and the partners to focus on fundraising versus actually deploying the capital and going through the harvest cycle. So I think actually not just at a foundational level in the technology are we seeing huge leaps and bounds in innovation right now, but we're also going to see the actual industry disrupted. And it might revert back to where it was 20, 25 years ago, where it was more artisanal. There weren't so many cooks in the kitchen. You had to watch where you step. You couldn't afford to have monster loss ratios in your portfolio just to chase one or two companies for that massive kind of outlier dispersion result.
Alex?
Yeah, I haven't been more excited about early stage venture in a very long time. I think we're entering a golden era of startups. A lot of that is driven by this AI innovation, where you have the ability of small teams to do what in the past required 100 plus people to do. I think Sam Altman talked about the one-person unicorn. I think one person is probably a little bit extreme, but certainly 5 to 10 seems doable in this environment. And for a firm like ours, we focus extremely on capital efficiency. That is perfect. That is exactly what we want to see. So we're going to see companies that are innovating at lightning fast speeds with not a lot of capital, reaching really high levels of revenue and high enterprise value creation in a short amount of time. So that's super exciting. The second trend, and I don't have an answer for this, but I wonder what happens to the capital stack, right? Because as these companies do not require as much of capital to get big, what happens to growth capital? What happens to that sovereign wealth and hedge fund capital that was pouring in over the last 15 years? It sounds like it should probably consolidate, and that might happen. I think that happens in the early stage venture game as well, but probably not as much because you still need really good managers to pick and find those scrappy teams. So it'll be very interesting to see what happens there. And then the third and final kind of trend that I'm seeing is the advent of completely new business models. And you're seeing this with kind of the combination of two sectors, which is AI and crypto and blockchain, where you have these AI agents that can go out and do things of public good, but they're funded by the tokenomics or crypto kind of backdrop that is fueling this. We have an example in our portfolio, a company that's in the distributed science space. And what they're doing is literally they have an AI agent that is going out and auditing academic research papers for errors. And there's no business model. There's nobody paying them to do that other than the token that was issued that is kind of funding that activity, right? And that wasn't possible before. So I'm fascinated kind of when you have the convergence of these two mega trends and in technology happen, what new models are possible. So that'll be interesting to see as well.
Ben, Alex, thanks for an insightful discussion. It's clear that private markets and AI are converging in ways that will change the financial landscape for years to come. So thank you very much.
Thanks, Brian.
Thanks for having us.
You've been listening to Crafting Capital, a podcast in partnership with custom content from the Wall Street Journal and UBS. I'm Brian Kamenetzky. Join us for more episodes at partners.wsj.com/UBS and on Spotify and Apple Podcasts.